Okay. Uh, Financial analysis, we have mentioned that it is the third step in the framework for financial statement analysis. And basically, in this class, we are interested to explore the techniques or the methodologies available for the financial analysis. It is concerned with looking at what happened in earlier time by examining the financial statements. Okay. So there are several techniques. So one of the most common techniques is using graphics. So what kind of graphics? Okay, I will explain detailed graphics, regression analysis, common search analysis, and the financial ratio analysis. So this is our topic in which we will spend most of our time, the financial ratio analysis. So you are very much familiar with using graphics because the graphics, using graphics saves a lot of words and tells stories in a simplest way and tells the story of number of pages using a simple graph. So this pie chart, for example, is reflecting the operating profit of a certain company, Colgate, based on the geographical segment from which a geographical location this company is generating more profit. So it is very much clear that Latin America is contributing more operating profit relative to the other geographical segment for this particular company. So this operating profit is a kind of it is a kind of number. A number, I mean, not the ratio type or the relation of something. Rather, it is an absolute number, it's a numerical number, and you can reflect it in the graph. Okay, so it is a kind of simple pie chart. Alternatively, you can also use the bar chart, and we can also use the column chart, and we can also these are some common graphics people use for showing what happened to the financials of this company in previous years. So it is for the purpose of or it is done by the analyst, and if you have the opportunity to write down or read a equity valuation report, you will see a number of graphs they are using for these purposes, for the purpose of financial analysis, that reflect the stories in terms of some graphical graphs. Okay. Nowadays, these simple graphs are no longer used. People, for attracting the investors' attention and to make the equity valuation report more attractive, people use innovative data visualization techniques by using some advanced software, in addition to the usage of Excel, kind of Tableau, kind of Orange, kind of R programming, this softwares. They use some data visualization techniques for the same purpose, to make some graphics for reflecting the financials, I mean the previous of the previous years. Okay, so over time you need to learn that how can we create graphs, and in this class will not help you to make these graphs or use the data visualization techniques. Rather, I will encourage you to explore this more from the web resources, because that will be part of your equity valuation report when you will be really preparing this. Then the regression analysis, which you have learned from your applied statistics course. You are supposed to learn the regression analysis, examine the relationship. So how it is useful? It is useful when you make some forecasting. by looking at the past numbers. So what are the past numbers? Say, for example, here in this case, okay, some people are, please write, some people are writing their ID in the chat. Please do not write your ID in the chat. I'm not telling you to write your ID in the chat box. Rather, I'm telling you to write this in the Zoom profile when you are attending. So edit the profile name in that part. Do not write on the chat, and it is distracting me. Okay, unless you like to ask something which is part of our discussion. Okay, so let's say people have a big confusion. People here means the research analyst, that how we predict the sales growth of a particular company. A number of texts have been written to help the research analyst to predict the sales growth. Okay, it is a very complicated task, but very essential task which one cannot avoid. So typically there is a good relation between the GDP growth and the sales growth of a conventional company or of a matured company. Matured company should expect that their sales growth will be in line with the GDP growth. So it is a conventional belief, but you need to explore it, you need to examine it. If you see that when you are making a scatter plot, you probably have learned about the scatter plot from your applied statistics course. So when you have plotted the sales growth in the previous years and the GDP changes in the previous years, corresponding years, and after plotting the scatter, the scatter plots, if you see that trend line can be clearly drawn, and plots, the dots, which indicates a relationship, these dots are very close to the trend. They have a common tendency to close to the to be closer to the trend. In that case, you can expect that there is a good relation and between the sales growth and the GDP changes, and you can think of GDP growth when you want to predict the sales growth. But you see that obviously there is a relation, but that relation is close to 26.87%, and you see the beta coefficient, that is the 0.1176, and it is possible if you make the regression. So it is used by analysts, but not by all analysts, but it is also one of the practices for the financial analysis for examining the previous financials. Okay. Now, next part of financial analysis, the next technique is the common stage analysis. So what people do in a company or in an industry, there will be a number of companies which have different sizes. So how can you compare? It might be difficult to compare one company with another company. So there's a technique which is called common stage analysis. In this case, we can express the financial statements data relative to a single financial statement item or base number, which is a kind of, in case of income statement, you can take it as a sales. In case of balance sheet, you can take the total assets as a base. So in case of vertical common size, think of a company, of a particular company. This company has a total assets of certain value, and other assets, other liabilities are here. Obviously, there is a total liabilities and shareholders' equity is here. But in vertical common size, what is done, all these numbers, all of the liabilities and shareholders' equity numbers, and all of the assets are expressed in terms of the total assets. So how? Say, for example, total asset is 100 and cash is 10 taka. So in that case, I will write 0.10, and here total asset is equal to 1. Say inventory is 30. I will write here 0.3. What I am doing, I am expressing these items of the balance sheet in terms of base, which is the total asset here. So that's why it is possible. Say for another company, you can come up with similar calculation. You might come up with a 15% of their asset is cash and 40% of their asset is inventory in this way. So this is a kind of vertical common sense, because we are in the vertical, we are limiting ourselves in the vertical, and we are limiting, we are looking on a particular column. Okay. So in case of income statement, the base will be the total net revenue. Say cost of goods sold is 50 taka and sales is say 100 taka. I mean in terms of taka. But when you will make a vertical common sense income statement, what will happen? You will write here cost of goods sold is 0.5 and the sales is equal to 1. So you can easily expect that out of 1 taka sales, 50% go to the cost of, for the purpose of cost of goods sold. So in case of cash flow statement, usually these bases are taken, either sales or assets or total in and out. And what it indicates how your balance sheet is composed or how your income statement is composed. And you might look at which item is more dominant in your balance sheet, or which item is dominating your revenue earnings. Okay. And in horizontal common sense, why it is done, it is particularly done in case of a particular single company. And at a particular for different time periods, I mean from year to year, or it can be from quarter to quarter, reflecting relative to a base year. Say for example, we are right now 2022. So okay, so 2022 financial statements are not available. 2021 financial statements are available. Take 2020 and 2019. Let's say 2019 is our base year. So the numbers are here, the actual numbers. I mean, for example, for income statement, say it is here we have the sales of 100, cost of goods sold of 20, then the advertising expenses 10, the profit is say 5, in this way. So in 2020, what we have observed that it is 110, then 30, then 15, 20 in this way, or 130, 25, 10 in this way. Okay, think of it as sales, it is COGS, and it is advertising expenses, it is profit in this way. So what is done in the horizontal common sense analysis? One base year is considered, and the financials of other years are expressed in terms of the base year. So for 2019, the sales will be 100. This is not this 100. This 100 is the base, and cost of goods sold is also okay. Cost of okay. Let's complete the sales first. For 2019, you see that as I have expressed all this in terms of 100, you might get confused what I'm doing here. So you see that if we look at the percentage, we will conclude that 2020 sales of 110 is what percentage of 2019 sales. So it is actually 2020 sales is 110 and 2019 sales is 100. And if we express this in terms of percentage, what we will get? It is 110%. I mean that it is 2020. 2020 sales is 110% of the 100 sales in the 2019. And Are you getting this? I mean, the 2020 sales is 110% of 2019 sales. If the 2020 sales figure is 110, and if the 2019 sales is 100, 110 is what percentage of 100 sales of 2019? Is it 110%?
Yes, sir.
Okay. So in this way, you will proceed. Similarly, 2021 sales of 130 is 130% of the 2019 sales. Okay. So here you can write 130. So note that I have taken the 100 numbers for the purpose of convenience, but these are the actual sales number. These are the percentage numbers. In the horizontal common size analysis, you are taking a particular base year as a base for the base consideration, and we are proceeding in this way. We are not proceeding in this way. Okay, here we are proceeding in this way. That's why it was vertical. Here we are proceeding in this way. That's why it is horizontal common size analysis. So if you see that for 2020's say profit has become 4 times greater. If it is 5 taka profit, I mean in 2019, and if it is 2020 profit, 20, the 20 profit is how much of the 2019 profit in terms of percentage? Is it 400%? If the 5 is 100% profit, 400%. So it is a very significant change. So you might be interested what happened to the rise of unexpected increase in the profit. I mean, this 400% jump of the profit from the previous year is a thing we need to explore more. Okay, in this way, common size financial statement works. Okay, this is an example what we are discussing. You see, when we are comparing 2 periods, so it can be 2019, it can be 2020. Okay, so here you see that this is vertical common size analysis. In terms of the total assets of 100, all items have been reflected. You see that from 2019 to 2020, in the asset composition, which has increased significantly. Receivables, which has increased significantly. The cash, receivables, inventory, fixed asset. So increased from which period? The period 1 or 2019 period, right? So the question is not, you cannot convince yourself just by looking that 35% of this company's total asset are in receivables in 2019, and now in 2020, 57% of this company's assets is receivables. That is all your explanation is done. It's not like that. The purpose of the financial analyst or the objective of financial analysis is to find out the reason. Can you recall that I mentioned that you have to look for the story, and now here you have to look for the story. What reasons are responsible for jumping of the receivables from 35% of assets to the 57% of assets? Or the company was the company very much aggressive? Was the company very much aggressive in recognizing sales? So recognition of sales is accounting policy. There is a number of ambiguities in recognition of sales. Okay, so there should be a reasonable understanding that the sales has been generated. Okay, so what kind of recognition of sales is aggressive. Let me give you an example. Say, as the financial statements are prepared based on accrual basis, so increasing receivables is also increase your sales. So in any way, if you can increase your sales, you can get a good amount of profit. Remember, this profit is not a cash item. This profit is an accounting item. Okay. So for the purpose of accelerating profit, or for the purpose of enhancing the profit percentage, managers may be engaged in aggressive recognition of sales, which will also increase the receivables amount. So what I was saying in the example part, that say inventory which will be sold is still in your showroom. Customer has not picked up the inventory. In that case, there is a risk that customers will reject the transaction and customers will not take the item in any way. If it is still in the place of seller, is it likely? When the inventory is in the place of seller, not in the place of purchaser or not in the place of customer, is it likely that customers may reject the transaction between the seller and him? What do you think?
Yes, sir, it's likely.
Likely. So if seller, instead of delivering the inventory to the place of customer, recognize sales when the inventory is still in the place of seller, in that case, the managers might be more aggressive in recognition of sales. So you have to look at this, you have to look at very carefully that what is the sales recognition policy, or what is the, more precisely in terms of the accounting standard, what is the revenue recognition policy of this firm. So remember, it comes from the guideline of accounting, more precisely the accounting standards, that when you can recognize that revenue has generated or revenue is to be generated. Okay. So these are the some kind of stories or the some ways that you have to explore. And this is another way of looking at the common size. Here we are comparing two companies, but at the same time, it is known as.
Are these accounting policies must be followed by companies, or they might be followed by the companies?
They have to follow the accounting standards. They have a flexibility that which accounting standard they will follow. But when they will follow one standard in a particular year, they have to confirm that they are following the same standard for a reasonable number of years. They are not changing their policy from time to time. Okay.
Okay, sir.
Okay. So it is a comparison of two companies in terms of the common size financial statement. You see that in the balance sheet, the company 2 has more receivables relative to company 1. Again, you have to look for the reasons why the company 2 is generating more receivables relative to the company 1. Is it like that company 2 is actually getting more sales, or company 2 is taking more discount policies, or company two's product is more attractive to the customers? What is the actual reason that why the receivables is getting more relative to their peer company? Okay. And from the time series analysis, when it is also part of the time series analysis here, this part, when you are comparing the financials from time to time, you're also making a time series analysis. So if you see that from the, say, from 1997 versus 1996, the revenue for the Sunbeam company has grown by 19% and receivables has grown by 38%. The inventory has grown up by 58%. So you see, when the revenue is growing up, at the same time, if you see that inventory is piling up, it may be for a reason. It should be in line. The inventory growth and the revenue growth should have a relation. But if you see that inventory is piling up more, in that case, inventory growth is likely to be greater and relative to the revenue growth. So again, you have to look for the reason why the inventory is piling up while the revenue, it is not following the revenue growth, and what are the reasons why they should have a relation. And the final one, the financial ratios in which you are more interested is the financial ratio analysis. So we are much familiar, many of us are much familiar with the financial ratios. So I already have mentioned in the previous class that it will not be our purpose to help you to learn how to calculate the financial ratios. Rather, we'll be more interested to learn to find out the reason, find out the good reason or find out the bad reason, why this ratio is greater or why this ratio is lower, whether this greater ratio is good or whether this lower ratio is good, and why this ratio is getting bigger or why this ratio is getting smaller. We have to find out this reason. That is the purpose of the financial analysis, and that is also our purpose. So it is just kind of recap that what is the financial ratios, and we'll also review some background of the financial ratios that will remind you that what is the ratio and what is not the ratio, and when you will be using the ratio, what should be your motivations, and if you use the financial ratios, in which areas you need to be very much cautious, and what are the caveat you need to look at. Okay, so what do we do in the financial ratio analysis? Say, for example, operating profit margin. We are saying that operating profit margin, you can what we do, we make a relation between what, say, operating profit margin. This is operating profit. If we divide this number by sales, we get or revenue, we get operating profit margin. So you see that these two items in the financial statements stay separately. And from the financial statement, we do not see any relation. But financial ratios help us to draw a relation by dividing the operating profit number by the sales number. So it helps us to draw a relation. And this number indicates a relation. And what it does, it also standardizes the financial data. By which way? By expressing it in terms of percentage or times or daily or days. So you probably have learned that number of days in accounts receivable, which indicates that how faster you are clearing the receivables due. And this is a standard reflection of the financial numbers, which is not possible if we do not take the help of ratio. And when you have the ratio, it is possible to make a comparison, because if you like to compare the Apple with Xiaomi, Apple is a big company, much bigger company, and Xiaomi is a relatively smaller company compared to the Apple. So in that case, if we have the sales number, say 10 trillion, and if we have the 1 trillion here for the Xiaomi, we cannot say that Apple is doing better in terms of the sales relative to the Xiaomi, unless we make a ratio that how good it is and to make this number comparable. If we see that their previous year sale is 9 trillion, and if we see their previous year sales is 0.5 trillion, we will see that there has been a how much growth? 50% growth, and their growth of sales is less than 50%. So in terms of the sales growth, Xiaomi is doing better related to the Apple. So this sales growth, what we are doing, sales of the current year divided by sales of the previous year, T minus 1, it is the current year T. So financial ratios helps us to make the comparison. There are some other motivations, we'll look at those. And the ratios are interrelated. How ratios are interrelated? Because if you look at the return on equity, this return on equity can be expressed simply profit. It could be after-tax profit and average shareholders' equity. But we can make a breakdown of this in this way. Which is the sales divided by assets, which is the turnover ratio. And we can also express the profit here, profit divided by sales. And we can also make leverage asset over equity. It is the leverage. It is the leverage, it is the profit margin, and it is the turnover ratio. So you see that how these are interrelated. And it is the turnover ratio, it is the profit margin ratio, and it is the leverage ratio. So you see that return on equity is related to this ratio. These three are separate ratios. And if you see other things remaining same, if leverage goes up, return on equity goes up because of this relation. So this that's why the ratios are interrelated. Okay. So are you familiar with this kind of decomposition or breakdown of the return on equity? I believe at least some of you should be familiar. Anyone?
Yes, sir. Yeah, it was basically in our investment analysis course. There is the breakdown.
Okay, so it's a breakdown into three ratios, and it was first shown by the DuPont company, which produces plastic materials, and the HP uses the raw materials from the DuPont. HP laptops use the raw materials from the DuPont company. That DuPont company does exist. That DuPont company has started using this kind of breakdown first to identify that what is the likely driver of the return on equity. And this ratio is very much, critical ratio to the shareholders. They look at that how much profit the company is generating for us for each dollar invested as equity by us. So they are very much interested to look at the return on equity. So let me ask you a question here. I have written here average shareholders equity. I have written here average shareholders equity. So it actually means the beginning shareholders equity. I mean the period beginning. I mean if it is 2021, the January 1, what would be the beginning equity plus for 2021, 31st December equity is the ending equity, and make the average of this, and that is the average shareholders equity. Now, this is the way how we calculate this kind of ratios. Now, the question is why we use the average instead of using either beginning period equity or the ending period equity. That is the question to you.
Sir, basically, in the financials statement position, the equity that is stated at the end of the year, that is the equity on that day. But the return that has been generated over time, the equity was not the same. Maybe for that reason, they take an average so that it can reflect the overall equity of the whole year.
Okay, that is an interesting answer. And it is a kind of technical answer, but I'm more interested to get some qualitative reason. Obviously, it is a technical answer that the balance sheet number reflects number on a particular day instead of a period. But the numerator, the profit is reflecting the performance over a period of time. So to make the things comparable, we need to find out the denominator, which also reflect the things for the period. Any other explanation from any one of you?
So since the equity figure can fluctuate over the accounting period, shareholders can use the average figure of the overall period's equity.
Okay, that answer is more qualitative, what I was expecting from you. Excellent. It is commonly believed that, or shareholders believe that they have invested equity in the beginning of the period, and it should be the denominator. But company has understood that over the period of time, equity are invested in terms of retained earnings, in terms of new equities, or in terms of repeat public offering, whatever it is. So not only the beginning equities are invested in a company for whole period of time, rather equities which also comes during the year or during the period. So it will be the return what will be generated on the for the whole period. The contribution of this return come from, or the driver of this return come from not only the beginning equity, rather the equity which also comes during the period at different point of time. So it will be better if we take the average shareholders equity by taking the average from the beginning and the ending shareholders equity. So there are some other motivations for using the financial ratios. And one common motivation cited by the analyst or cited by the accounting, what I already have expressed, that there is a difference in the size. and that size difference has influence on the performance of a company. So what Apple can do because of its bigger asset size, the Xiaomi cannot do the same thing. So it will not be apple to apple comparison. Apple to apple, I'm not here indicating the Apple company, I'm indicating the fruits. Make the things comparable, the comparable things should be apple to apple. So to make the comparison apple to apple, you need to control the differences between the or among the comparables. So Apple and Xiaomi are much different in terms of the size. So if we control this by taking their sales number as a denominator and take the profit of this company as a numerator, we are controlling the size of the sales. How? We can say that for 1 unit of sales, Apple is generating $0.2 profit, and for 1 unit of sales by Xiaomi is generating $0.25 of sales. So it is only possible if we express the number in terms of the financial ratio. So what we are doing here, we are controlling the differences between the company in terms of the size by expressing the number in ratios. But if we had the number like 2 trillion for the Apple and 0.5 million profit for the Xiaomi, it would not be good if we make a head-to-head comparison in this way by looking at the absolute numbers. Okay. So you know about this very well. So let's proceed to what is the another motivation. You probably have spent time to understand the regression analysis in your applied statistics course, and there you have seen this kind of equation in multiple regression. Okay, then can you recall this kind of equation you have seen in the regression analysis? Anyone can confirm? Okay. So it is assumed that the error term, what you will get from the regression, which we get by error term by subtracting the actual number, say actual number is y, and the predicted number by using this model. You have a predicted number, you get the error term, which cannot be explained by the model you have cited or you have come up with your analysis. Okay, so this is error term. So in the regression analysis, there are some strict assumption that if you cannot satisfy this, your regression analysis is invalid. If you cannot satisfy this, your regression analysis is invalid. I have repeated because you will do mistake when you will make the regression analysis next year for the purpose of dissertation or for the purpose of your project paper. Okay, so remember the error terms, one of those assumptions which need to be satisfied is error terms should have homoscedastic distribution. Homoscedastic distribution. Okay, it cannot be like when you are increasing the, or when you are plotting the predicted value, say here, and you are plotting the error term here. it should not be like that arrow term is moving across the movement of the predicted value. So here it is kind of heteroscedastic distribution of the arrow term. So it needs to be homoscedastic. So it should be constant. The arrow term should be constant when the predicted value is moving. Okay. So this is a kind of recap of the regression analysis. For what purpose? For the purpose of one of the motivations of ratio analysis. So if you take, remember, what was the x1, x2? These are some variables, right? These are the some variables in regression analysis. So people are, I mean, not people, students. Students are very likely to prefer the absolute number of sales, absolute number of profit, or absolute number of fixed asset or debt to use this in regression analysis. But it has been observed when you use this absolute number as a variable in the regression analysis, most often you come up with a regression which does not satisfy the homoscedastic distribution of arrow terms. So what is the solution? Solution is using the ratio. How? Say, instead of using the profit, you use the profit margin. So you express the profit in terms of sales. Instead of using the fixed asset directly, you use the, say, ratio in terms of fixed asset turnover. So in this way, you make a solution. Clear? So these things you need to keep in your mind. Okay. Next thing, the prove a theory in which a ratio is the variable of interest. So theory. So theory is a kind of thing which comes from some empirical research. So let me give you the hint of a simple theory. Say, receivables divided by sales. What does it mean? Is it a kind of receivables turnover? Okay, think of this ratio, receivables divided by sales. How much of your sales is in terms of receivables? Okay. Obviously, receivables is attractive and receivable is a good option for increasing sales. But here my question is, if you find two companies, one company out of their 100 sales, one company has 90% sales in receivables and another company is
Sir, what
their
does it
sales.
mean by receivables divided by sales account receivable turnover? So is it the formula? Is it the formula for account receivable turnover?
No, it is not a formula for account receivable turnover. I'm just the account receivable formula is in this way: sales divided by receivables.
I'm not getting the point. What you are meaning by this ratio R divided by sales?
Okay,
Could you
here
repeat, sir?
it is not the ratio divided by sales. Here it is the receivables divided by sales. You are getting an information from this ratio that how much of your sales of, say, out of your 1 taka sales, how much of your sales is in receivables, through receivables. Say it is 0.7. Okay, out of your 1 taka sales, 0.7 taka is through receivables. And another company in which case the receivables is 20 for 1 unit of sales or $1 of sales. Which company, other things remaining same, which company is to be preferred by you?
So the company in which has receivables of 0.2.
Okay, so there is a theory. The point of giving this example is to give you the background of a theory. There is a theory that the companies which have more receivables, the companies which have more receivables, this one relative to their sales, they are more likely to engage in manipulation of earnings. They are more likely to engage in the manipulation of earnings. Have you got the statement, what I just have mentioned?
Yes, sir.
Okay, so to prove that theory, can you look at just the receivables, or you need to look at the receivables in terms of the sales? Absolute receivables will not tell you anything. But if you look at the receivables in terms of sales, you'll get the things whether the theory is saying something probable or something not convincible. Okay. So there are a number of theories. This is just kind of example that for the purpose of proving some theories, the financial ratios is essential. And there is another example that some empirical regularity that people look at, the regulators specifically. Regulators look at some ratios to regulate the companies. So for example, there is a regulation in the banking industry that out of their total capital, if their capital is 100 taka, they cannot give a loan of 25 or more than 25 taka to a particular company. It is for the banking companies regulation. Out of their 100 taka capital, they cannot lend a company, say 30 taka. A single company, they cannot lend how much? 30 taka. They can lend maximum how much of their capital?
25%.
25% of their capital. You have seen this reiteration or again the repetition of the regulation in the previous week newspapers mentioned by the Bangladesh Bank or explained by the Bangladesh Bank. Okay, so you see that in terms of the capital, your lending cannot exceed 25% to a particular company. So you see that this is also coming from a financial ratio. Okay. So why Bangladesh Bank does this? Because Bangladesh Bank knows very well from the theory and empirical evidence that there will be a likelihood of getting default, and there will be a likelihood that bank will be incurring more a single exposure limit. The term is more appropriate, the single exposure limit. When you are engaging or when you are getting engaged to a particular company heavily, you are increasing the likelihood of getting bankrupt. Okay. So for these purposes also financial ratios are used. So we have looked at some motivations on reason why we need to use the financial ratios. Now we like to review, or we like to give you some hint that behind the use of financial ratios, there are some strict assumptions. So one of the strict assumption is that financial ratio is a number which reflects a strict proportionality. What does it mean actually? You probably have learned the capital asset pricing model, right? So what does capital asset pricing model is saying? Capital asset pricing model is saying that risk premium of a security, risk premium of a security is strictly proportional to the beta. Risk premium is strictly proportional to the beta, and it is the market risk premium. Market risk premium. Okay. So say, what does it mean, the proportionality? I'm just reiterating the concept of proportionality because I'll be using this concept heavily in the coming discussion. If the beta is 2, it indicates that if the market return is 1%, risk premium should be 2%. Risk premium is equal to beta times the market risk premium. And if beta goes up to say 2.5, in that case, the risk premium should be 2.5%. So which is directly driving the risk premium? The beta, market beta, I mean the stock beta, more precise, stock beta is driving the risk premium, what should be expected by the investors. So beta is a proportionality factor. Risk premium is directly proportional to its beta. Risk premium is directly proportional to its beta. So why we are using the concept or reiterating the concept? Because financial ratios indicate some strict proportionality. So a strict proportionality here, we are indicating that when you are comparing the ratio across firms, I mean the cross-sectional comparison at a particular point of time, say 2021, you are comparing Square, Beximco, JMI, Orion, all of these companies. In that case, it is you are comparing across firms at a point in time. It is a cross-sectional comparison. But if you are comparing a particular single company for different time period, 2021, 19, 20, in that case, you are doing a time series comparison. Whatever the comparison you are doing, when you are using the financial ratios, you have to assume that ratio indicates some proportionality. So let me explain it more with an example of a ratio, that is the earnings to sales. So think of it as a profit margin, earnings over sales. Okay. So when we are writing earnings over sales, we get some number, say 0.2. So this 0.2 is a number which indicates the proportionality, factor. Think of the beta, what we mentioned earlier. This 0.2 is a proportionality factor. What does it mean? If the sales goes up by 1 unit of this particular company, the earnings should go up by $0.2. If the sales of a particular company goes down by 1 unit, the profit of the particular company should go down by $0.2. Okay. So here we have used a simple model where we can think of this, that earnings is directly proportional. Earnings is directly proportional to the proportionality factor, and proportionality factor here is coming from earnings over sales, or P equal to earnings over sales. So the ratio, which ratio is using, that ratio indicates a proportionality factor and this kind of relation. Okay. So let's think of if proportionality is not maintained. You see that if sales goes up and earnings also goes up, and there is no other influence on the earnings, they are directly proportional and there is no constant. You see that when we have written the risk premium and risk premium, then the equal to beta over the market risk premium, we have written no constant. That means all risk premium should be explained by beta. Here, similarly, all changes in the earnings should be explained by the sales. All changes in the earnings should be explained by the sales. That is the understanding of the proportionality concept. But and there should be a linear relation. There should be a linear relation. But you see that it is possible that there is a non-proportionality without constant, and it still without constant. There is we are expecting that the changes in earnings will be solely explained by the sales. But here you see that no proportionality because we are not getting a linear relationship. And here the line is linear, but we are getting a negative constant. It is a negative constant. How it is possible? What does it mean? Say sales equal to 0, but you are incurring some expenses for which you are getting the negative earnings. How it is possible? What kind of expenses can still needs to be incurred when your sales is 0?
Fixed cost.
Fixed costs.
Okay, that is good. And another thing, non-proportionality with constant earnings. Non-proportionality with constant earnings. Here we are also seeing a negative constant. But here the difference between these two is that we have assumed no constant here. We have assumed a constant here. But how these two and these two are different? Here we are getting a proportional relationship, but we are not getting a proportional relationship here. So when you are interested to a ratio, we need to look for that whether they have a proportional relationship or not. If the things are like that, they should not have a proportional relationship. In that case, using financial ratios or forcing financial ratios to draw a relationship is not a good idea. Okay, so there can be a non-linear relationship between the sales and economics for a number of reasons. Not for a number of reasons, for a specific reason. One reason can be if the firm enjoys some kind of economies of scale. And in a two-variable model, what we used earlier, that earnings is directly proportional to the sales. But what is the happens in general, that earnings is not a function of sales only. Rather, earnings is function of number of variables. Okay, so it is kind of more general model. And the relationship between earnings and sales, and the relation between earnings and employees, or relation between earnings and number of tenants, can be linear, can be non-linear. But there are a number of possible relationships which can exist. So other than the sales, if you find that sales is not, say earnings and sales does not have a proportional relationship, in that case, you cannot use the sales to control the differences in the size. Rather, you have to look for alternatives. So there are some other alternatives you can use if you get that that factor has the more proportional relationship between that factor and the earnings. So the ideal candidate can be total asset, shareholders equity, market capitalization, these things. Okay, but how you can do this? How can you prove that there is a proportional relationship? So you need to find out, either make a scatter plot or make a trend analysis, and you need to check how these two variables are moving. And if you see that they are moving in a trend line, they have a very close relationship. They are, though it's not strictly proportional, but they are close to strict proportionality. In that case, you can use that financial ratio, and you can use that denominator as a for the financial ratios. Okay, and most often people cite the reason that I use the financial ratios because I think that the size is not important. Rather, if I express the profit in terms of the sales and I control the differences between the firm in terms of sales, in that case, I will come up with a good conclusion. But it has been found in the empirical evidence that sometimes size is important. The differences in size tells many things which often get silent when you are controlling or when you are restricting the role of differences in size. How we control the differences in size when we are taking as denominator in the ratio, I mean the sales. But what is the limitation of this? The limitation is that sometimes it is observed, not sometimes, many times it is observed that the large firm is less likely to become a failure in the performance, and smaller firms are more likely to become failed in terms of the performance. So when you are ignoring the differences in the between these companies in terms of the size, we are ignoring a critical variable. Okay, so we often come up with a number for the ratio. That is the understanding in your intermediate education. But remember, a ratio is not an answer. It is only possible in exam. Rather, ratio indicates something. There is nothing that calculates the profit margin. You will come up with an answer. You will come up with a percentage, but rather it indicates something, and absolutely the percentage 15.26% tells nothing to you unless you compare this 15.26% with the profit margin with some another company or of the same company with previous years. Okay, so the ratios can be classified into categories. It can be activity ratios, it can be profitability, it can be liquidity, it can be solvency. So there are some ways that how the ratios can give you the meaningful indication that how the ratio is useful, that when you are comparing from previous year to last year, your profit margin has improved. And when you're comparing and make a cross-sectional comparison, you're comparing your company's profit margin with another company. Okay, and note that carefully, the computation is not equal to analysis. So I'm reiterating several times that computing financial ratios is not our goal. Rather, we have to find out the reason behind the rising of a ratio or constant movement of a ratio or declining movement of a ratio. These things we have to find out the reason. What are the strategies company has taken for getting this ratio? What are the roles the company is applying for getting this percentage, and what are the reason? Whether the company has changed their accounting standard by this time, we have to find out this. Okay, and we need to be very careful that every time all ratios are not relevant for all cases. We have to find out which ratios are useful for which user and which ratios is not useful in some cases. And companies often make differences in terms of applying the accounting standards. So this is a big limitation of financial ratio analysis when you see a good amount of divergence in the comparable companies in terms of the accounting standards. Okay, so there are some issues which we need to be careful in calculating ratios, not only for this course, but also for your actual financial analysis, and also for your the term paper, what you'll be doing in this paper, in this course, the equity valuation report, and also using the financial ratios when you will use the financial statements for the purpose of your dissertation. Okay, so first thing we like to highlight, that is the negative denomination or negative denominator. Say for example, you have the profit as a numerator and denominator is shareholders equity, and the profit is positive, for example, but shareholders equity is negative. You will get a percentage, obviously, say 5%, and that 5% is negative percentage on the return on equity, right? Does it indicate anything? Profit is positive, but your shareholders equity is negative. That's why you have come up with the return on equity, which is negative, because the denominator is negative. Does it give you any sense? Is it possible that shareholders equity becomes negative?
No, sir.
Not
I don't
possible?
think it's possible. How is it possible?
How is it
Because,
possible?
sir, is it possible when the bank, the company defaults? I mean, in case of bankruptcy, is it possible that time?
Okay, bankruptcy is a big thing. We are not inviting bankruptcy, any bankruptcy when we choose to call it. Rather think of a company of which it has accumulated loss. You see that accumulated loss summed up to retained earnings. And if you retain earnings, you know the composition of shareholders' equity. You know the composition of shareholders' equity.
Sir, equity statement.
I mean, you know how to come up with a shareholders' equity number from your financial accounting course. Okay, you will explore it. You'll see that retained earnings is summed up to the equity value to get the final shareholders' equity. Okay, so if you have accumulated loss, obviously that will also invite the bankruptcy later. But if you have the accumulated loss, it is likely that your shareholders' equity becomes negative. In that case, you'll get a negative ROE and it will tell you nothing. So what will you do? What people do? People simply do not like those companies. That's why they delete those observations. They delete those observations. Okay. But that is not a solution always. You have to find out what reason are responsible for this negative shareholders' equity. Is it for, I'm not getting my pen. Okay. So what sound I'm getting? Someone is memorizing something. Okay. You see that what we are saying, that we have to find out the reason why the shareholders' equity has become negative. For example, why? Is it like that the company is near to the bankruptcy? That's why the denominator has become negative. or there are some good reason that which can be looked for. Okay. So if it is found that the assets of the financial statements are undervalued, they need some revaluation. They need some revaluation. If it is possible that after revaluation of the assets, your shareholders' equity becomes positive, in that case, do this. Okay, it is one solution. Another solution is to keep, instead of using this denominator, come up with another denominator which is positive. So what we do usually, instead of using the negative shareholders' equity, we write here the average asset. It reflects the return on assets, but no longer return on equity. But we have come up with a solution without deleting the observation from the sample. Okay, so it happens, and you have some constraint. Why you have some constraint? People use the computerized financial statement. Say people use the financial statements number from the Lanka Bangla financial portal in Bangladesh. And globally, people use the computed data. It is a database, computed data for the financial ratios. But in the financial ratios number from the computed data, if you get the net income negative and the shareholders' equity negative, and you do not have the background information in the database, you do not have the financial statements, the actual financial statements, in that case, you have no solution. You can either delete the observation, or you can make an alternative ratio. Okay, so these are the some issues for the negative negative denominator. Okay, someone has raised hand.
Sir, I have not understood the point how shareholders' equity can be negative. So can you repeat it again?
Okay, you please visit the financial accounting and look at how shareholders' equity is composed. What are the components in the shareholders' equity? If you see the shareholders' equity components, you will see that equity, the beginning equity cannot be negative. The ending shareholders' equity can become negative because of the accumulated loss which added to the retained earnings.
Okay, now, sir, I have got the point. Yes, sir.
Okay. Now another thing, okay, I'm taking the extra time from you. And now we are considering the issue of outlier. So what is outlier? Say, for example, you are familiar with mean, median, mode, minimum, maximum, right? From your statistics course. So you know that what are these descriptive statistics of a particular variable, say, for example, ROE. So what do you expect? That ROE is sometimes, say your mean is 0.2, maximum is 0.6, this way. But if it is like that, say your ROE has become 5. For some reason, you do not know what happened. Or your ROE has become like 0.0002. Some strange numbers. So it appears that it is not following the descriptive statistics of the whole observations. It seems that something wrong happened. So these are some numbers which might look like outlier. Why they are outlier? Because it seems that they are very much different from the descriptive statistics from the whole crowd. People often cite that CGPA 4 is an outlier. relative to the average GPA of the classes. And also if I say that my CGPA is 1.5, you will also say that my CGPA is an outlier. Okay. So this definition is, outlier definition is subjective because you have to find out the enough evidence that it is outlier based on you are comparing with what? You're comparing with your descriptive statistics, what I just have mentioned. So what are the ways how you will deal with this outlier? If it is really outlier, how you can deal with this? You have to find out the extreme value, what has been happened. Is it for a recording error? It actually happens. It actually happens when you record the financial statements in some computerized Excel format. You might miss some values. And sometimes the financial statements itself will give you some wrong number. They often make correction in our country. They make revision. So it can happen due to recording error. And if it is like that, you do not have the source that you can compare with. Okay. So what can you do? You can compare the ROE. Say I'm talking about the ROE of a company which is 5. You're comparing the ROE of the same company in previous year. You are seeing that ROE of that company in previous year was 0.3. And ROE of that company in the next year, I mean of this year, you see that it is 0.7. So you can easily understand that probably something is wrong. Something wrong happened that it has become 5. So you have to find out the reason. And if you see that there is no recording errors or there is no other such kind of error, and what is the second step? You have to find out whether company has made changes in accounting classification, accounting methods, or there has been any economic or structural changes for this extreme observation. So accounting classification can give you some extreme numbers in some years. Say, for example, one thing is a company has a write-off, a company has written off a machineries in a particular year. So that is a big number. Say for writing off that asset, a company has incurred a significant amount of loss. In that case, that will take your profit number to an extreme number compared to other years in which you have not done this kind of transaction. So we have to find out the reason what happened. And we also have to compare some ratios which are interrelated to find out whether any accounting standards has been changed. Say, if you compare the operating earnings to sales and earnings before interest and taxes to sales, EBIT to sales and earnings to sales, if you see that there has been significant changes of this number 1 and number 2 relative to the earnings to sales, you have to believe that there has been some changes in the accounting revenue recognition policies, or there has been some change transactions which happened for which the earnings to sales is significantly different from the operating profit margin. And if some reason in a particular year for economic reason, company is enjoying some good advantages for the cheap labor, it can also reduce some expenses. For this reason, extreme number can arise. And it also happens during the merger and acquisition when two companies combine their businesses. You might observe some extreme numbers in financials So you have to find out the year in which the merger happened. So if it is 2020, you have to be very careful in looking at the numbers of 2020 because the merger transactions has happened and you need some adjustment for considering that outlier. So there are some solutions, obviously. So we'll talk about the solutions now. So when you are faced with extreme observations, very easiest solution is deleting the extreme observation because it is a true outlier. Another solution is that retain that extreme observation because it seems it indicates something which is exceptional. And when when you are retaining this, you are considering some extreme situations also in your analysis. And another solution which I like to highlight that is Winsorage, that is usually used in the academic research. Winsorage is a thing. Let me give you an example that are you familiar with the percentile? Are you familiar with the percentile from your statistics?
No, sir.
You did your applied statistics? Sorry, business statistics or basic statistics. You did your quartile, first quartile, second quartile, third quartile.
Yes, sir.
Okay,
Yes,
so
sir.
percentile is
Yes,
there.
sir.
Yes, sir.
If you classify your numbers in 100 percentiles, 100 groups, you can have a percentile. Okay, so you see that most of your observations will be covered in 1 percentile to 99 percentile. Okay, so there are some outliers in this region. There are some outliers in this region. So what is the application of Winsorage? Winsorage is a statistical technique. What it does, that the value which is greater, which is not covered, say, which is greater than the 99 percentile number. Winsorage is a technique that value, that number, or that it can be any number, it can be financial number or it can be a ratio. Say that say 99 percentile of the return on equity is say 60%, and your extreme outlier of return on equity is 5. Okay, so what Winsorage does, Winsorage reduce the 5 return on equity which is exceeding the 99 percentile to a closer number to 0.60 to bring it within the 99 percentile. So 0.60 is the return on equity in which 99% observation is covered, right? 99% observation has return on equity below or equal to 0.60. So when you will make the Winsorage, what will happen? This 5 return on equity will come to a number, say 0.61 or 0.62, which will become closer to the 99 percentile number. So there's a way that I will make a Winsorage between 1 to 99%, or I'll make a Winsorage between 5 to 95%. It's not like something you are deleting something. Rather, you are making adjustment to the extreme observations by making the Winsorage. Okay. And trimming is a way that you are deleting the top n and the bottom n observations. Say you are deleting the top 3 observation, you are deleting bottom 3 observation. So these are some solutions for dealing the outlier observation. So what is your task? Your task is to look at these ratios and review this. And we will have a discussion on these ratios, not how to calculate these ratios. So we'll assume that you know how to calculate this. Rather, I will ask some questions from you that how you want to explain this number. Okay, that will be part of our next class. But before that, before finishing our this class, I just like to show you a template about which I mentioned in previous class. that you will, you see my Excel? You see my Excel?
Yes, sir.
Okay.
Yes, sir.
So you see, this is a kind of template, which is ready-made. So it is from Mastering Financial Modeling text. So you have to work with this kind of template, or alternatively, you can prepare your own template. But for this purpose of for the purpose of this course, we'll provide you some ready-made template, and over time you have to learn that how can build up own template. Okay. So what does the template does here? You see that there are some sheets: income sheet, balance sheet, the ratios, cash flow. Okay. Income, balance, ratio, income and balance. These are simple income statement and the balance sheet. So what we need to do, we need to give input of the numbers of our selected company into the cells. Say the revenue, cost of sales, the depreciation, the finance cost, investment income, exceptional expenses, this way. And these ratios are, formula has been inserted here already. So formula will calculate the gross margin, profit from operation. I mean that this number will be calculated automatically. And you have to insert values on the cells in which you see there is a blue shade. Okay, there's a blue shade, not the white shade. And you see an application of common size financial statement. Okay, we mentioned about the common size financial statement. It is a kind of horizontal analysis. It is a kind of vertical analysis because all are expressed in terms of the revenue. Similarly, it is for balance sheet. You have to insert the balance sheet numbers for your selected company in the balance sheet. Okay, there are some ways that what you need to do. You can insert new rows here in this way. You can insert new rows. Okay, say for example, you want to insert a new row here. You select in this way, you click insert. Because your company has a current asset which you are thinking that it will not be covered in marketable securities, it will not be covered in cash and deposits. I'm very confident that you can insert the values into these cells. Okay. Now, the first task for us, the financial ratios. You see, I have mentioned the categories of financial ratios: core ratio, profitability, operating efficiency, financial structure, cash flow ratios, the growth formula, and it is the application of your DuPont, the return on equity breakdown. You see, there are some references which also indicate the formula which have been used. Okay, and this formula have been already inserted here. So you do not need to do anything here. Rather, you have to learn by yourself what happened here and what is happening here, because these ratios will be automatically calculated when you will insert the number in the income sheet and in the balance sheet. So your ratio sheet will automatically be prepared. Clear? So there are some general kind of remark here that how you can come up with the okay, better, worse comment. But I do not expect this kind of a statement from you. Rather, I will expect some stories that what might be the reasons for increasing these ratios over time, or what might be the reason for decreasing these ratios over time. So your task after completing the financial ratio class is to work on this sheet by giving insert of income statement number and balance sheet number. Okay, you can even go to the sheet from using the macro command here, but you see all numbers have been expressed in terms of million. Okay, and that's why I have written here the million. Okay, so you see actually this number 177.8 is expressed in terms of million. So when you will change it here, say for example, if you change it, if you can change it, if you change 3, 4, 5, 6, 7, 8, 9. Sorry. Okay, it should be written in this way: BDT So I have written in 3,000. So what will happen? It has been changed to BDT 1000 from the BDT million. Okay. So in this way, you have to learn that how to work with the financial analysis template. Okay. So this is all about our today's class.